Welcome to the weekly video update, where we'll go over the action in the market for August 1st through the 5th, and then see how things look for the week of August 8th through the 12th. For the third time now, we've had a positive week, so things are still looking to improve. Still a long way to go. The weekly charts are starting to improve. The daily charts are pretty much positive, even though Thursday and Friday last week we had down days. They were very small down days. We're still looking a little bit short-term overbought with some of our daily charts. So that might mean that we could see some sideways to slightly down action. But as always, when we get to an overbought condition, we can still go further and just become more overbought. But by and large, things are looking a lot more positive. The one thing that threw the market into a bit of a frenzy on Friday was the employment situation report. Most of the economic reports that we've seen come out have been showing weakness. Well, then you have employment, and that was much, much stronger than expected. And that's kind of thrown into confusion this idea that maybe inflation has topped out. It's also thrown into confusion to say, okay, we have negative GDP, which is the definition of a recession, but employment usually really suffers during a recession, and it's looking really strong right now. Now, we don't know the quality of these jobs. We just go by what the numbers tell us is happening, but we have to evaluate things somehow, and employment still looks to be holding up. So let's go back and talk about the week session. This is the third week now that we've had a positive week. Wednesday was the strongest day of last week, and that really kind of shifted things. We saw small declines in the S&P on Thursday and Friday. And earlier in the week, we saw a weaker ISM manufacturing index, and that's an important report. And that kind of fueled this idea that maybe things are going to top out and start coming down as far as inflation is concerned. Oil prices ended up closing below $90 on Friday. Then you probably heard about this in the news where the Speaker of the House went to Taiwan. That really doesn't impact the markets that much unless something negative had happened. Of course, after the trip ended, there's been some talking back and forth between China and the US. We'll have to see if that turns into anything more than just yelling back and forth at each other. Growth stocks, small caps and mid caps also had a pretty good week overall. Not so much in a percentage gain basis, but they're holding up, and we're seeing some advances in specifically small and mid caps, where growth stocks are still looking okay. Took a bit of a hit on Friday with the down day, but overall things are still looking better. Earnings season, we're right in the middle of it right now. So we're getting all kinds of earnings reports pretty much every day. Then this is the other thing I mentioned, that the employment situation report, it was much stronger than expected, more than double what they had planned on for new jobs, and everything pretty much increased in the other reports that come out last Friday. So that's why we had the down day on Friday. And then it's likely still at this point that the Fed will focus on inflation, which means rising interest rates. And then when they really are convinced that inflation is under control, that's when they do a pivot and they shift away from worrying about inflation as much and then focus more on, okay, let's get the economy looking better. And if we have to do it, we'll lower interest rates at that point. That's kind of what the market's waiting for. And we go back and forth. We've been spooked a couple of times with this in 2022, only to have the inflation scenario still come back to the forefront. All right. Some other things that we can say is we were just up 0.36% for the week. Volume was below average. We're in the dog days of summer. And the fixation is the technicals, or are the technicals, and that we're showing a lot of improvements with our weekly charts that I'll go through. Inflation and interest rates are the real concern right now. There's a whole list of geopolitical concerns, but those are kind of on the back burner. They might be leading the news, and it might be something that you focus on personally, but from a stock market perspective, it's economic things that are really influencing the markets right now, specifically as they apply to inflation and interest rates. We still have the supply chain issues and oil, which is now starting to drop. We have some Fed speak and policy that came out last week when the Fed met. We'll just have to see. Is Chairman Powell going to give any speeches? Is he going to do any interviews or something like that? Earnings, as I mentioned, we're right in the middle of earnings season. And then recession fears, with one of those fears being, what is a recession? Because we have the textbook definition, and then what we're hearing others say that we're not necessarily in a recession right now. Our trend is weakening. It's still a trend, but it's starting to come down. And I'll show you that chart. Here's the intraday chart going back to Monday, where we finished down a little bit. And then we had a big gap lower, only to see a nice little recovery on Tuesday. Gave up a lot of that and ended up closing down on the day. So that could have looked a lot more positive, but didn't end up working out that way. Wednesday was the real powerful day where we didn't keep going lower. We set kind of a base and then shot right up, and that set the high for the week. And then Thursday was pretty much sideways. Friday was a roller coaster. We gapped lower, came up to the unchanged level, went back down, tried to come back up, went down, came back up. I mean, it's a real seasick day overall. So the Dow was actually down 0.1%. The NASDAQ up 2.2%. The S&P up about, well, I have it as 0.36%. They rounded it up to 0.4 here. And the small caps were up 1.9%, where some of the charts that I show that the small caps weren't up all that strong. This is from Friday to Friday, where a lot of the charts that I show you just are the 5 trading days that we went through. And here's one of them. It's just showing for the week how the NASDAQ and the NASDAQ 100 had pretty good weeks. The S&P was up. The Dow was up slightly, and I have to cough. Sorry about that. And then we had the NYSE, the small caps, and the mid caps from Monday to Friday actually showing a little bit of a decline. Now going back to the all-time high, the NASDAQ 100 and the NASDAQ, they've suffered the most, but they've been roaring back the most as the market makes an attempt to recover. Our different sectors for the week, we had tech and communication up over 1% overall. And then we had healthcare, materials, real estate, energy was down the most. And a lot of folks thought maybe getting into energy was a good thing to do. And when you have en masse, a whole lot of investors jumping into a particular sector, many times that means it's pretty much topped out, at least in the short to intermediate term. And that's looking like what has happened. Then looking at all the different sectors for the past week, tech and communications, they've really been suffering a lot in 2022. And the financials have suffered, but they were positive on the week. With discretionary, it's trying to make a bit of a comeback as well. And then we had energy way over on the right-hand side, the best performing sector of 2022. Well, it was down the most in the previous week. Looking at current market valuation, we're still at fairly valued. I don't know. Some of the charts are looking a little bit more extreme, but this is the model score overall. We're above this dashed line, so that's positive, and we're not above this yellow line. We're kind of right in between. So that's when we get more of a fairly valued reading overall. One of the charts, the Buffett indicator, it's starting to look a little bit more extreme. We have the historical average, and this measures stocks versus GDP and compares the two. When we get up to this red line and go above it, we're considered overvalued at that point, and that's where we are. Then we have the PE ratio. It's also still looking a little bit overvalued. This dashed line in the middle is the historical average. We started to come right back down to this yellow line, but as prices go up and we're not really seeing follow through with earnings, especially on a trailing basis, this starts to become slightly overvalued again. Then margin debt, this has really dropped down, and it's actually undervalued since we're below this dashed line. I'm sorry, we're below this black line, and we're going down below this 1.5 standard deviation line as well. People aren't using a lot of borrowed money right now to buy stocks. Then we have the inflation adjusted S&P 500, this dashed line going up, that's the historical trend line. When we get really far away from that, that means that we're getting a little out of hand. We've been coming back down, but now we're starting to turn back up again. And then the spread between the 10-year minus the 3-month spread, that's getting really close to going inverted. If it gets all the way up to this red dash line, that means that we've inverted on those yields. We're not quite there yet. And a lot of economists use this to measure whether we're in a recession or not, or whether this is signaling a recession, where a lot of other folks, they use the 10-year to the 2-year. Well, that's been inverted for quite a while now. We're waiting to see, is this going to go inverted as well? Looking at sentiment, as of Friday's session, we're neutral. We're right in the 50 area. And here's the historical chart where we had spent a lot of the time down below 25. Well, as the market's showing some improvement, this is starting to come up as well, but not necessarily extreme. We're right at the midpoint. Here's some Isabel net charts. This is just showing flows going into different assets. Equities, which means stocks, that's this dark blue line, how it's still doing quite well. Then the lighter blue line down here, and it's a little bit more pale. These are corporate bonds. Not as many people get into those. The orangest line are government bonds. And then you have a lot of people that are in cash right now. They're in money market funds. This could be positive for the market because they're just waiting on the sidelines. They don't know what to do. And if the market really gets going and starts going up, and we're still seeing a lot of positive signs in our charts, but if those folks jump in and start buying, that could really give some more support to prices going higher. Here, this is just looking at quarters when we had big drawdowns, like during the recessions and so forth. Well, down here at the very bottom, with the quarter ending June 30th, we were down 16.4%. The average 1 month later is 5.4% up. 3 months out, 6.2%, and then 3 months out, then 6 months out is 15.1%, and a year later is 36.1%. So once we hit a low in a bear market, and of course we don't really ever know if that's a low. It's looking like a low now, but they're assuming that the low has been put in as of right now. When you're looking at this chart, you pretty much have 100% advance from this point forward. Another way to look at this is we had a really rough first half of 2022, and a lot of times the second half will show a pretty nice recovery. Doesn't mean that that's what's going to happen, but we have seen that before. These are the private sector financial assets, according to the Bank of America. Just looking at this, this is the US private sector as a percent of GDP, people that own stocks. And it's really shot up and is starting to come down again right now. We're at 6.3 times of GDP currently. Here's another one just showing flows into financial stocks. That's starting to show some improvement. On the short term, which is just a week by week measurement, this has gone positive. What we also follow is this darker blue line, which is a 4-week moving average of these lighter blue lines. So that's starting to show some improvement there. Insider transaction ratios were below this black line, so we're still in this bullish area right now. Insiders, this is legal insider transactions or trading. These would be people that own a large percentage of the company, the CEO, the corporate officers, the people that really understand what's going on inside of a company. And if they really know what's going on, and if they're going to put their own money on the line and buy some stock, a lot of people use that as a mechanism for making decisions. There's also the illegal insider trading, which is where you spread non-public information to somebody else. They benefit from that, but the whole public didn't get to hear that information. And that's kind of what the very first Wall Street movie was about, was insider trading. And that's why people ended up going to prison after that. This is IPO activity, initial public offering. When the market's going up, when prices are higher, that's when we see a lot of new companies willing to take their companies from being private into public companies and making their stock available on a stock exchange. When we're going down, we see that activity really start to decline. As the S&P has been coming down, we have seen a real trailing off of those companies filing to go public. And then the pricings of when they first start trading, we're also seeing that really decline as well. So this just bodes for the idea that the stock market isn't really strong right now. So a lot of companies that are considering going public are deciding to wait, or at least not do it at all now. This is the equity allocation. It's set up at 63%, meaning that 63% of the Bank of America investors that use them on an assets under management, they're into stocks. When we're above this blue line, that's stocks. When we're below this lighter blue line, then we're into other things, or usually bonds at that point. And then this is looking at employment. When we see the temporary help services really start to decline, that's the red line. And then we see the GDP also going negative right here where these red arrows are. That usually signals that we really are in a depression. The problem right now is we've gone negative with the GDP, but we're still looking pretty good as far as the jobs that are available out there. And that's what's making this a little more cloudy right now. Then the inflation and the Biden approval rating. As inflation goes up, that's this light blue line. The rating for whatever administration is in power, that will go down, even though we've seen a little bit of a bounce lately. Then the past week, we're seeing kind of a midpoint reading between those investors that use Ridex bullish or bearish mutual funds. They're coming out of the bearish funds. That's what happens when this really spikes up. When it gets really low, that means folks are in the bullish funds. Well, we're kind of right in between right now. We also have individual investors. After being extreme negative, they're starting to feel better about things right now, and not necessarily an extreme reading. They're still overall negative because we're below zero, but this is showing some improvement. The VIX continues to decline on the weekly chart, both on the line and the bar chart. The Ulcer Index, and I've been using this in my daily videos. This is more indicative of what we're seeing, where fear got really high. That's when we set what could be the low. And as the S&P has been going back up, this fear gauge has really been coming down, where the daily chart is just not helping us. Copper, it is starting to rebound a little bit after having a really nasty decline. So, but we're not really seeing any big shift in the trend right now. Some of our different scenarios that we're watching, where the VIX spiked up a while back, and I don't know why I keep calling this the VIX. This is the 5-period moving average of the equity put call ratio. And now it's starting to come down. And sometimes when we spike up like we have, that we've been at or near a low in the S&P 500. This is the one that I'm really focusing on now, is the sector rotation, where at the end of 2021, we started to get out, or the smart money started to get out of growth-oriented stocks and get into value-oriented stocks. We saw a real divergence late in the year, and the market's really been having some trouble. Well, we're seeing just the opposite of that, where the S&P is making a lower low, but we're seeing a positive divergence when looking at the Qs, which are growth, against the S&P 500, discretionary and growth versus value. Now, it took a little bit of a hit. This is a daily chart, but overall, we're above the moving averages, and the moving averages are going up. Here's another chart showing large, mid, and small caps on a daily chart, how they've been advancing nicely. And to me, this suggests that the smart money is getting out of value and rotating back into growth. And that's when you see a pretty healthy stock market environment. Doesn't mean it's going to go straight up, but it just means overall that the people that really know what's going on, they're starting to shift how they're viewing things. Another thing we're watching is the 2-year Treasury yield. It's a little bit hard right now because we may have spiked right here, but we're not very far away from that spike. So this could end up going back up, take out this spike, and create a new one. But sometimes that marks an intermediate to short-term low in the S&P. This is the one that's looking the most positive to me anyway, where we're still having a valid spike with the staples to S&P 500 ratio. And now the staples ratio is really declining. And if you look, this is often marked a significant low in the S&P 500. Again, it doesn't mean it's going to go straight up, but it just means overall, this could really help the overall market climate. Looking at some earnings and valuation, this is the Shiller PE ratio, where we're at 31.10 right now, where the median is between 16 and 17. So looking back and using the ways that this chart is calculated, we are still overvalued as far as the stock market is concerned. Here's some earnings updates from FactSet, and it just says that the earnings surprises and the magnitude of those surprises, they're going up, and the earnings growth rate for the second quarter is higher today than we had it a week ago. But the number and magnitude of positive earnings surprises are still below their 5-year average. On a year-over-year basis, the S&P is reporting its lowest earnings since the last quarter of 2020. Big surprise. And the lower earnings growth rate for the second quarter, which what we just finished, we're in the third quarter now, relative to recent quarters, can be attributed to both a difficult comparison to unusually high earnings growth that we saw back in 2021 and continuing macroeconomic headwinds, inflation, interest rates, geopolitical concerns. Those are all macroeconomic headwinds. And then it also talks about the below average number and magnitude of positive earnings surprises. 87% of the companies as of August 5th, Friday, they've reported their actual results. 75% of those that reported had earnings that were above estimates, which is above last week's percentage of 73, but below the 5-year average of 77. Yeah. So overall, the earnings that have been reported are 3.4% above estimates. Last week it was 3.1, but below the 5-year average of 8.8. Blah, 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 blah. It's still holding up, but not looking as strong as it was. However, it's looking better than it was a week ago. That's my takeaway from this. Another one is, and this came out on Monday, analysts are making larger cuts than average to their earnings estimates for the S&P for right now, for the third quarter. And it just says, given the decline in GDP for the second straight quarter, analysts are starting to lower their estimates more than normal. Are they doing this? Yes. In July, they lowered their estimates for the third quarter by a larger margin than average, blah, blah, blah. But here's a chart down here. And way over on the right-hand side, this is just showing how a lot of these analysts are really lowering their estimates. Just something to keep in mind, because that'll ultimately flow through into prices. Here are the earnings estimates for Morgan Stanley. Overall, I don't know if this is really helpful or not, because we don't have a real historical chart of this to show how it changes. So, but I'd like to include it because some folks find this useful information. Right now, we still have a ways to go. The next Fed meeting is September 21st. And as of right now, we're still looking at a 75 basis point move, or 0.75%. They're saying that's a 68% chance. Now, these charts change every day. And as the reports come out, these will go all over the place and the adjustments will be made. But this is just how it looks as of the close on Friday. The Fed balance sheet is showing a little bit of a decline right now as they try to let bonds expire or get rid of the bonds that they were using to help prop up the market. All right, breadth. Let's go through some of our charts. Showing a bit of an advance based on price, but a bit of a decline based on volume last week. The advanced decline ratio is pretty much flat with the 19-day exponential moving average and a little bit higher with the 39. New highs and new lows. This has been a bit of a concern on the daily charts, and it's also a little bit of a concern here because we've been chopping around these levels for quite a while now. We haven't broken out enough to give these stocks a chance to create any new highs. We'll want to see that change if prices go higher. Accumulation distribution, still looking okay. The blue line is above the red line and both are advancing. Our trend, the ADX is still pretty high, but it's crossed below the moving average and starting to come down. Now, if you are more aggressive with this indicator, you might suggest that the trend is finished. If you're a little more conservative, you want to wait and see this drop all the way down to below 20. Different investors will interpret this a different way. We have to default to negative because the red line, although it's declining, is still on top. And the green line is on the bottom, but is starting to show a little bit of an advance. Then the Arun is showing that the red line, that means sellers are in control on the weekly charts, where they're on the daily chart, the buyers are in complete control. We're kind of just seeing a flip flop on this chart. The green line just shows that there's been a decrease in selling, but we were flat overall. However, this chart is still negative because the oscillator is below zero. The mass index, we're still coming off a valid signal for that. Doesn't tell us the direction, but it does tell us that something big should happen. And so far, it's looking like that should be to the upside. Longer term, the decision point made some changes recently. Right at the end of June, you had both of their short-term models change to positive. Then on Wednesday, you had the intermediate term. It went from neutral to positive, where all of the other models that they study are still negative. Here's the daily chart. We were able to get above the S1 pivot level. Can we get back up to the monthly pivot? When we're below this, that's considered negative. If we can get above that, that's considered positive. And you can see down at the bottom where volume was below average. We're still below the 50-period moving average. The long-term trend is still negative, but showing some improvement. And that's what you're going to hear on a lot of these charts right now. Bullish percent index on the weekly chart looking pretty positive. We broke above 70. This is extreme positive, but we could still go higher with this. Chaikin oscillator also showing in advance. Chaikin money flow saw a little bit of a decline, but is still in an overall uptrend. The force index showing some improvement. McClellan oscillator coming down a little bit after giving an extreme positive reading. Summation index based on price and volume are still positive. All of our oscillators are turning up. Well, the KST, not quite there yet. And the tricks. These are longer term oscillators where the PMO and the TSI and the weekly charts are turning up. The Swinland trading oscillator is showing a decline based on price and volume. That's a little bit of a concern. And we're seeing the same thing on the daily chart. Even on up days, the STO continues to decline. So we want to keep an eye on that. Sometimes this can be a leading indicator for us. Other times it leads us astray. So we just want to be careful. The PMO study shows a little bit of a decline with the PMOs that are rising. The buy signals after being extreme positive is starting to decline. The PMOs that are above zero continues to advance. The RSI, just a smidge above 50. So that's slightly positive with the RSI 14 period. There, the other PMO study, it's trying to turn back up, showing an advance based on price as well as volume. Special case, still positive on the weekly chart. It's turning up a little bit on the daily chart, but it's still negative overall. And here's the same chart again. The Stoke RSI still looking extreme positive, and the Williams percent R still looking positive. The Vortex indicator showing an improvement, but the red line's still on top. However, it is declining, and the green line is advancing. Ultimate oscillator, just a little bit below being extreme positive. The money flow indicator, bit of an advance. The Bollinger Band slightly above the 0.50 level, so that's considered positive. 0.5 is the midpoint in the Bollinger Band, and when we're above that, that's considered positive. When we're below it, that's considered negative. When we get to the upper or lower band, that's when we've gone pretty far extreme. The KST, as we showed just a second ago with our momentum indicators, showing a little bit of an improvement here, but it's still negative. The PPO, this has crossed over positive, and a lot of folks really like this indicator. It's similar to the MACD, similar to all the other oscillators that we use, but this looked negative for a long, long time, and now it's finally crossing over positive. The rate of change going back 1 week is just slightly positive, even though it declined. 50 period, flat to slightly higher going back a year. We just go back 50 weeks. The Copic curve is looking more positive and could be generating a signal. The weekly Fibonacci chart, not really in danger of, well, I'm mainly looking at this right now as a support, and we're far away from these right now. Our different charts, the Heiken Ashi looking positive, Kegi positive, Renko still negative with the 3 red blocks, ease of movement looking pretty good with the 14 period, but if we just go back 1 period, we saw a decline. Point and figure, we're seeing this same thing on the daily chart we're working off a triple top breakout that was generated July 18th. No new X's or O's came into the chart this past week. 3-line break, also still looking positive with the open bars. Different trading systems. The Elder is still positive and coming right up to this moving average, 65 period moving average. The parabolic SAR, we have another dot underneath. That is positive. Looking at the broad market. Again, I just look at this without any indicators just to compare, and it looks like they're going in fairly the same direction. We're not really seeing any major divergences, either positive or negative right now. All stocks still in a negative downtrend, but showing an improvement. And that you're going to hear that. Same thing with the mid caps, an improvement, but negative. Small caps, improvement, but negative. The Dow, improvement, but negative. The NASDAQ weekly chart, improvement, but negative. NASDAQ 100, improvement, but negative, blah, blah, blah. I could just put this on a loop over and over. NYSE, Wilshire, the FANG stocks, ARC even, and the dynamic, or the 30 biggest software companies, they are looking a little bit better, but still negative. Here is Dow theory. We just look at this chart, the transports and the Dow seem to be confirming each other. Utilities are up a little bit more. They spiked up and came back down, but they had a pretty good week this past week. Looking at some other indications, this is a weekly chart of the CRB index, still in an overall uptrend, but showing some weakness now. Gold came back down and it was able to rebound slightly, but is still in an overall downtrend. Silver also in a downtrend, tried to make a bit of a rebound this last week. Oil has now dropped down below 90. The dollar still holding up, even though it saw some weakness overall, but it's in an uptrend, both on the daily chart and on the weekly chart. Looking at some bonds where we might be setting a bit of a base here and bouncing up out of that, even though we were down 1% on the week. Treasury yields were going down overall. This is a daily chart. Well, they spiked up when we had that employment situation report come out on Friday. Some relative studies, bonds are still underperforming stocks, but we had a recent golden cross here. But is that starting to break down? Here's the stock to bond ratio monthly, where it just shows that stocks are starting and have been continuing to outperform bonds. Here's our intermarket analysis chart. Oil was flat on the week, up 30%, and then you have the dollar. Everything else is negative with gold, stocks, and bonds. And then the gold to US dollar ratio on the weekly chart just shows the gold is showing a little bit of a bounce back up as the dollar saw some weakness. The gold to S&P ratio, where gold has been really starting to underperform the S&P, but it's still in an overall uptrend, meaning gold is doing better on a relative basis. The low volatility stocks, they're still in an uptrend, but showing some weakness. Growth to value, overall downtrend, showing some improvement. The NASDAQ 100, more growth to the S&P 500, which has growth and value, showing some improvement with the NASDAQ 100. The S&P 100 is kind of bouncing around, but showing still some improvement. Discretionary, which just been getting hammered when compared to staples, it's now starting to show a nice little bounce, but it's still negative overall. Energy, which had been the main sector of the year, that's really been falling off as tech is starting to show some improvement. So then what's our outlook? On Wednesday, we don't have any reports coming out on Monday, nothing of real significance on Tuesday, but Wednesday we have the biggie, CPI. That's the inflation report. And that is what the markets are really going to fixate on. Then on Thursday, we have the PPI. That's the producer price index. That's another biggie, but not quite as big as the CPI. And we have jobless claims. We want to keep an eye on that because of the employment situation. And then on Friday, we have the preliminary reading of consumer sentiment. So what we're watching are the technicals looking a lot better on the weekly charts. We're still positive on the daily charts. Can this continue to keep going? With inflation and interest rates being the real concern, we have that whole list of geopolitical issues, Russia, Ukraine, China's the supply chain, China just period with what they're starting to say. Is that going to turn into anything? Or the military exercises going to be even more escalated than what they've been around Taiwan? Oil is starting to really drop. We have Fed speak and policy, which may or may not happen. Earnings are going to be coming out. I've taken Italy off the list on the daily charts or on the daily videos because the situation with the prime minister, that kind of gone off the table for right now. Japan is still dealing with a longer term economic problem that could eventually feed into the US. And that's why you're seeing their interest rates flat, where the rates in the US, UK, and Germany just really go up. And then if we do start to fall, those people that do use margin to buy stocks, they may be getting some margin calls, but we're not, unless we see some real catastrophic thing happen, the market is showing a lot of improvement right now. Okay, our scenarios, we're not in a downtrend right now. And this is based on the daily charts for all the reasons that I just talked about, because on the daily basis, the technicals are showing a lot of improvement, but Thursday and Friday were down days, and we might see some more down days as the market works off some of the short-term overbought readings that we're seeing. We are in an uptrend on the daily charts because the technicals are positive. There's still a real disbelief that the market can go higher. And then we have this fear of missing out. If we do really get set and go higher, all that money that's on the sidelines, all these investors that don't know what to do, they might jump in because they're afraid they're going to be left behind as far as the returns that they're seeking. The scenarios that we're looking at on the daily charts are still looking pretty positive, with the sector rotation going from value back over into growth. And we have a lot of positive setups. And please watch the daily videos to keep up with those. Technicals are showing a lot of improvement. We've got above some of the moving averages on the daily charts, and we're not really sideways right now. You could say it because on the daily chart, the ADX is above 20 and it's positive. Where on the weekly chart, we're seeing the ADX still very high, but it's going down below and declining below the moving average. So however you use that, you might have different interpretations of that indicator. So thank you. Have a wonderful week. I will be posting the intermarket analysis video here shortly over the weekend. I have some new shorter videos that I'm going to try to launch here in the next day or two that some of you might find helpful. So I'll talk to you next week.